Good morning. How are you doing?
Good morning.
So this morning, before we get started, I've got Teresa and Marilyn from Frontier Title Group, and they were generous enough to bring us breakfast this morning. So thank them for that. And I wanted to give them a little bit of time to kind of talk to us about what's going on in title, what might be coming up in the new year that might be changing. So without further ado, I'll let you ladies.
Excellent.
Go for it.
Where do you want me
You can come up this way, sure.
Good morning, everybody, and thanks for having us in. We really do appreciate the opportunity to say hello and bring you guys breakfast and just let you know that we're here for you. Marilyn Elliott runs our Hudson office, which is on 52 in Hudson, and I run the Trinity office, which is on 54 in Starkey in Newport Richey. And between the two of us, I don't even want to say that we have well over 50 years of real estate title experience, like closer to 60, but I don't want to age either one of us too
Both
much.
started when you were 12.
Yeah, exactly. I've been doing title since I was 4 years old.
And I've known her probably both of them just as long.
I was gonna say, I moved to Florida in 2002, and I met Tina shortly thereafter, so I've known Tina for most of my real estate life here in Florida. And we just, again, wanted to say hello, good morning, bring you guys some breakfast, let you know that we're here for you. If you guys have any questions or concerns whatsoever. The only new thing that I have to share with you guys as far as title goes, which affects you guys in the real estate market, is FinCEN. And I don't know if you've heard that term yet or not. It's an acronym, it's FINCEN, and it is the new upcoming law that's going to go in effect in March of this year, which has to do with cash transactions and corporations or LLCs. So if you're doing a cash transaction and it's John Smith and Susie Smith, no concerns whatsoever for anybody. But if you're doing a transaction and it's ABC Corporation purchasing or selling a property, and a lot of us have those type of clients that are investors, LLCs, and corporations that flip properties and whatnot, and this is definitely going to affect them because as part of, and I'll just read the first line here, the Financial Crimes Enforcement Network is a U.S. Treasury Bureau that combats money laundering. And this is specifically what they're looking for. So any real estate transaction, all cash involving LLCs or trusts is now what they're considering at risk for money laundering. So moving forward, starting in March, we have to report every single one of these transactions.
Yeah,
I know, another hoop to jump through, another hurdle to jump over, just new requirements. And from your standpoint, it's really just being aware that from a title company standpoint, that we're investigating now these people with cash money. We're just not saying, yeehaw, bring us all the cash, we'll take it in a bag. It's not quite like
We
this.
still will, but
We still will, but now we have to jump through 4 extra hoops. So really, that's all I have for you. We also have some information on FIRPTA, which is my other favorite acronym, which is foreign income tax for foreigners. So if you have a foreign seller, obviously we want to know that up front so that we can handle everything appropriately, whether we're withholding tax or doing the exemption where the buyer signs off saying, yes, this is going to be my primary residence, and yes, I'm going to occupy it as my primary residence, because that's one of the only ways to get around foreign income tax.
now does FinCEN apply for trusts and things like that, or just corporations?
It applies for corporations, LLCs, and trusts.
Okay, that's what I thought.
because a lot of people are hiding, well, they're not hiding, they're creating LLCs that manages the trusts.
Right.
Yes.
Or
that's
vice versa.
Or vice versa, yes.
Yeah, create a trust, put your LLC in a trust. Yeah.
Will that
Yeah.
delay anything or anything?
It could potentially delay things if the LLC or the corporation doesn't have the proper documentation. Because what the government is looking for now is to see who that person is, who that entity is. We can't just say, ABC LLC with JJJ LLC as representative of ABC LLC. We have to list a person, we have to show their credentials, and we have to verify that they're a legitimate live person. Or the government's going to, yes, put the halt on it and say, I don't think so, or we need more documentation.
Yeah, we have a lot of foreign corporations who hide their money in LLCs, and that's what they're trying to get away with. Is like they put out this new law, what was it, a year or two ago, where it's like if you're from these countries of interest, you have to report it. So what they would do is they would open an American LLC with a trustee or whatever, a representative that was US based so they could get around it. Well, now the government's getting smart and saying, hey, can't do that anymore. We need to know who the person behind the LLC is, not just the official representative of the LLC. And so as long as the documentation is in order, it'll be fine. It should be able to be cleared pretty quickly, but for those who are trying to get around the system specifically, it's going to
And I think they're probably going to pay closer attention to these land trusts
Right.
that are blind trusts that don't list a trustee or a beneficiary, and you have to dig for that information. I think that that's probably what they're primarily targeting.
So for the majority of what we do, it shouldn't be a problem, but I would say maybe, 5%?
Maybe
Maybe.
5%. I personally deal with a lot of corporations, a lot of trusts, a lot of LLCs,
Gotcha.
because I have a lot of investors who I do business with, where Maryland handles more of the retail market.
Okay. Yeah, in Trinity with all that new construction on the 54 corridor, there's a lot of LLC, there's a lot of commercial development, residential, commercial, that kind of thing. So,
Exactly.
no, that's
So
good.
we're going to leave information on FENSN and on FERPTA on the kitchen table for you guys. If you have any questions, we'll stick around for a few minutes while you guys finish up your meeting. And
Awesome.
that's all I have.
Thank
Thank
you.
you.
Marilyn, did you want to add anything?
Well, the FinFin, they're gonna have to have tax ID numbers. Well, we have to report it to the IRS.
I think
See,
that
I don't even know that.
Yeah, no,
Yeah.
I worked at a title company for 6 months. I know.
Just 6 months?
Yeah. That was it.
That was it.
I
You guys
do
forget
know-
about it.
I do know we use Qualia as our closing software,
Yeah.
which is an online portal that you guys have access to. You can look in our file, see what's going on, add notes,
Yeah.
whatever you want. I do know that system has a platform specifically for FinCEN now. And I also know that WFG, which is one of our larger underwriters, is offering to do the recording,
Oh,
which I just saw, which I think is wonderful.
that's super helpful.
Yeah, I
Thank you very much.
saw that.
Thank you.
I saw that that's one of those things that's coming down, but I hadn't heard a lot of the specifics about it yet. So that's super
About the
helpful.
FinCEN?
About FinCEN, yeah. Okay, so originally we were going to have a therapist come in this morning and talk to us about some difficult conversations. Unfortunately, she had a situation come up that she had to reschedule, so we're going to have her next month. But one of the things that I think is helpful for a lot of agents, especially some of the newer agents, is knowing how to structure your taxes properly. So I know it's not quite as fun or engaging as having difficult conversations, but I want to talk about some common tax deductions. So I got this from a CPA, but understand it's general tax education. It's not legal advice. I'm not an attorney. I'm not a CPA, but I did get this from somebody who does taxes and CPA work. So the three things that if you take away nothing else from today, so basically your deductions have to be ordinary and necessary. So you can't go buy $1 million boat and write it off as a business expense unless you can justify that $1 million boat. And I'm not looking at anybody in particular, but there have been agents. So actually, I saw a case study on this where the agent bought $1 million boat and the IRS flagged it, and she showed that she had Shaquille O'Neal on her boat and other like high wealth clients that she was legitimately showing multi-million-dollar properties. And so she was able to kind of fight it and justify it. But for your average everyday, like we sell $5 million a year in property kind of agents, that would be a really hard thing. So if it's ordinary and necessary, It's not going to raise any red flags. If it's properly documented, this is what I always tell you, keep receipts for everything. Scan them, keep them electronically, because obviously receipt paper will fade. So, receipts from January, I'm probably not going to be able to read because that thermal paper just doesn't hold up well. So I scan all of my receipts and keep everything electronically. That way we've got legible copy. Excuse me. And then allocated reasonably between business and personal use. So most of what you have, your car is not going to be 100% for business. You're going to use it sometimes to run to the grocery store, to take your kids to school, whatever the case may be. And the IRS understands that. So you don't have to have something that is just dedicated to your business in order for it to be able to be a write-off. So if you keep those three things in mind, the rest of this is pretty easy. Now, something that I've talked to a lot of agents about, they're like, I'm really worried about taking these deductions because, I feel like the government's going to come after me or whatever the case may be. And the reality is the tax code is already written for this. As a 1099 contractor, we're not manipulating the system. We are using the system as it was intended to be used. So as a real estate agent, you run your own business. You're a 1099 contractor. Your business is your own. And understanding that you are a business owner should change the way that you think about how you pay taxes, because high wealth individuals are doing everything they can to not pay taxes. They're manipulating every one of these tax systems because that's what they're there for. There's a reason for it. So you're self-employed. There is no employer withholding. So from your checks, I'm not keeping, Social Security and all that stuff that you typically would pay into if you were W-2. You pay federal income tax, and in most cases, you're going to pay a self-employment tax. So deductions are used to reduce your taxable income, not just your taxable bill. And we have to walk a fine line, because sometimes agents will reduce their income down to like 30 grand a year. Well, the problem is when you go to qualify for loans, they're going to look at it and go, you only made 30 grand last year. So we have to kind of balance that out between, I need to make enough money that if I need to go get a new car, they're not going to look at it and go, you don't make enough money for this $50,000 car, even though we realistically do, and not having to pay taxes more than we have to. So the golden rule, expenses have to be ordinary, which would be common in real estate, necessary, and documented. Actually, I've got these, I'll slide them around, and for those who aren't here, I'll share it online. In order to qualify for deductions, you don't necessarily have to use perfect math. And what I mean by that is it doesn't have to be to the penny, but it should be reasonable. So, if you pay $19.99 a month, it's not unreasonable to say that you pay $20 a month for that service. Like, it doesn't have to be to the penny. It also doesn't have to be for zero personal use, meaning, like I said, you can use your car for some personal use and some business use and still be able to write it off. What is required is reasonable allocation and clean records, meaning you have documentation for it. So licensing, education, and fees. These are very common things that would never raise any issues and that a lot of agents sometimes overlook. So your Florida real estate license fees, when you pay to renew your licenses, that's a business expense. Your renewals, your CE courses, like I'm licensed in 7 states. I spend $1,000 a year on CE renewals because it's just what I have to do. Exam prep and testing fees, MLS dues. And I know all of those just came due in December or whatever it was. So those become business expenses. Your realtor association dues, your brokerage fees. So the $99 a month that you guys pay here is a business expense. That gets written off as well. And professional designations. This is one that a lot of agents miss. What I typically suggest is find a new certification every year and just go get it. Whether it's a buyer specialist or relocation specialist or green certifications or whatever the case may be. Those all become business expenses that you can write off, and it helps you kind of market to your customers to say, hey, if I'm focused on this particular area, I have a certification in that. And that may separate you from some of these other agents who don't. They're just kind of a jack of all trades. So basically, the rule of thumb is if the state or MLS requires it, it's almost always a deductible. So that's kind of your your North Star on this. Vehicle and mileage. This is the biggest deduction for most agents. So I technically opened the brokerage in March, started actually working in May, and I think I had 18,000 miles in business drives this year. So when I was fully transacting, it was 25 to 30,000 a year consistently. Now, this year in 2025, it was 70 cents a mile. So if you do 25,000 business miles a year, that becomes a pretty significant write-off for you at the end of the year. This year, it actually went up to 72.5 cents per mile for 2026. What I typically suggest is using a mileage tracking software. I use MileIQ and I love it. So it just runs in the background of your phone. Every drive you make, it registers, and then you tell it whether it was personal or business. If you make the same drive over and over, it'll ask you, like if you're taking your kid to school, it'll say, hey, you've classified this 3 times as personal. Do you want me to always make this personal? If you tell it yes, then you don't have to classify that drive anymore. It kind of learns your habits and patterns.
I had no idea.
It's like $60 a year, and you can write off the expense of the software as well.
Oh, yeah.
So this is a big one because,
man.
like I said, $60 a year to be able to write off 15, 16, 17,000
Yeah.
is a no-brainer. This standard deduction, so this is what most agents do. This would cover your gas, your insurance, your maintenance, your depreciation, all of that. You're basically taking it as a per mile rather than having to keep every gas receipt, every maintenance receipt, things like that. Some tips on tax deductible trips. So if you're doing showings, if you're going to listing appointments, if you're doing inspections or closings, MLS or brokerage visits, like if you guys are coming to the office for a meeting, that mileage is deductible. Client meetings. What's not deductible would be personal errands, taking your kids to school, things like that, or commuting to a W-2 job. So if you're a part-time agent, you have another full-time job, you can't write off that mileage because you're being paid a W-2, which doesn't make this deductible. The less common way to do it, so if you didn't do the per mile standard deduction, you would basically keep all of your gas repairs, insurance, tires, registration, depreciation. And this requires full tracking of business use for every single thing you do. It requires way more bookkeeping. You need a CPA to help you determine how quickly you're going to depreciate a vehicle. Is it on a 3-year? Is it on a 5-year? And you have to keep every receipt for the whole year. So what I typically tell agents is the 72 cents a mile, it's well worth it to just take the standard deduction, and your bookkeeping and everything is far less on that. And what I do is at excuse me, at the end of the year, MileIQ gives me the report. I give the first page summary to my CPA, but I keep the other 96 pages of every single drive I made, because if the IRS ever came back, I'd be like, here you go. Here's the 96 pages, dig through it and determine whether each drive that I said was business was actually business, personal. At the end of the day, your typical drives are like 70-30 to 80-20. So we do primarily use our cars for business purposes, but if you say that every drive you make is 100% for business, it's probably going to set off some red flags, because not everything we do is business. There are times we're going to go to the grocery store or whatever. So mileage is simpler to track and usually comes out better in the long run. And if you guys have any questions about any of this, feel free to stop me. Home office. So this is another one that gets often underused by agents. Now, these 2 bullet points are extremely important. You can use this if it's used regularly and used exclusively. So what this means is you can't have a guest bedroom that primarily gets used by guests, but you occasionally go sit at the desk in there. You need to have a dedicated space that is considered an office space. You can show this is not used for any other purpose. This percentage of my home is dedicated office space. And most of us have that. Like, we have a room that that's our business space. Primarily, this would be used for admin, contracts, CRM, marketing, things like that. Excuse me, sorry. For it to be deductible, it's based on a pro rata. So if that room, let's say that room is 120 square feet, like it's a 10 by 12 bedroom or whatever, and it's 120 square feet of a 1,200 square foot home, you would basically have 10%. So from that, you would do 10% of your rent or mortgage insurance, but not your principal, or the interest, not the insurance, sorry. Rent or mortgage interest. 10% of your property taxes, 10% of your utilities, your internet, home phone, your home insurance, whatever. That percentage of your home that you're using for business, you can deduct that same percentage off all of those. So again, this is one that a lot of people miss out on, but it might be, $1,000, a couple $1,000s a year. There's two methods for this. The simplified, which just says it's $5 per square foot. Sometimes this works better for renters because they don't have mortgage insurance, or mortgage interest, they don't have property taxes. Sometimes their home internet is included as part of their rental, things like that. If that's the case, you can do $5 per square foot simplified, or what most agents do is the actual. So the percentage of the home that's being used for business against each of those things. Home office deductions are safe when they're legitimate. And there was a myth for a long time that if you were using your home office, it was more likely to get you audited. And the reality is most people know what real estate agents do. They know that we don't go to an office every day. We work from home. That's kind of the point. So this does not have that. You're more likely to get audited if you use this. Same thing with phone, internet, and tech. Your cell phone, typically we use it, all of us, our cell phones are used 50 to 80% exclusively for business. Our phones ring all the time. That's what's on our website. That's what's on our MLS, our cell phone. So that gets pretty frequently. 50 to 80% is what the CPA suggested for it not to look unusual, because we're going to call our mom, we're going to call our sister, we're going to have personal conversations, but primarily our cell phones are ringing day in and day out with business use. Same thing with the internet. 50 to 90% of our usage is going to be for business. We're looking for properties. We're, doing market analyses and things like that. Some other things that would also be deductible, your CRM system. So if you have one that you pay for, obviously we provide you one at Veranda, but transaction management software, cloud storage. So if you have OneDrive or can't think of the other one, that you use for storage, basically like encrypted storage, you can write those off. Your email services, if you have a paid email service for encryption, you can pay for those. The other thing is AI tools. So this one is a fairly new thing, but if you have a paid version of ChatGPT or something else, that becomes a business expense because we're using AI for, and if we're not, we should be, which that's a class for another day. But basically what it says is use reasonable estimates. Consistency matters more than perfection. So again, if it's $19.99 and you say I pay $20 a month, as long as it's $20 a month for the 12 months, it's consistent, whatever the case may be. Those are the things that the IRS is looking for, is like 1 month you're paying $90 and then the next month you're paying $30 and then you're paying $60 and then you're paying $40. They're going to look at it and go, why are you spending different amounts of money each month? If it's consistent, then it tends to raise less red flags. Your marketing and advertising. So this is where it gets really clever for agents who do this right. Professional photography and video. When you guys have a new listing and you use a photography company, that's a business expense. You can then include that in your advertising budget. Listing marketing, social media ads, Google Meta, TikTok ads, website and SEO costs. But the big thing is signs and writers. When we get new listings, we got to go out and buy new signs. All of that is a business expense. Branded apparel. I've got a bunch of shirts that have Veranda Realty Group embroidered on them. Those all become business expenses.
Christmas sweater.
Yeah, exactly. Closing gifts with branding. So what I typically suggest is if you're going to do a closing gift, the IRS says that you can spend $25 per person as a closing gift. Typically, we all know that's
Wait.
crap.
What? $25?
$25 per person. So if it's a husband and wife, your closing gift is deductible for $50. If you do something that's a closing gift with branding, it now becomes marketing and the $50 cap doesn't exist anymore. So that's where I always tell them, be creative. And I'll just plug Christy for a second because she has Night Owl gifts. There are a lot of customizable gifts that you can have, and we can put your team name, your logo, just your name as an individual agent on it. That now becomes marketing and branding, and you aren't capped by that $50 limit. So you can do kind of a nicer closing gift, something that's going to set yourself apart with your customers, and you get the benefit of being able to write off the value. Lead generation platforms, obviously we give you one, but I know some of you have other ones that you use, so you can write that off as well. Flyers, postcards, and mailers. So if it generates business, it's usually deductible. The biggest thing with this is you need to keep receipts because you have to show who it was for. So what I typically tell you is when you pay for photography, keep track of how much you paid and what the property was. So that way, if there's ever a question, you can say, I paid $250 for this property. I paid $150 for this one. And you've got your running list of exactly what you spent. So if there's ever a question, you can go back and go, listen, pull it up in the MLS. I can show you. These were my listings. This is what I paid for, whatever the case may be. Office supplies and equipment. I typically get a brand new laptop every 2 years. I like
Yes.
tech.
Something every year.
Oh yeah,
Something,
for sure.
Yeah.
But my laptop is typically, it's $1,000 to $1,200, and I get a new one every 2 years. Monitors, printer, scanner, desk, chair, lighting, paper, ink, postage, lock boxes, open house supplies. So what I would tell you is every year, get something new for your business. A new computer, a new desk chair, a new
Scanner,
whatever.
You know.
Exactly.
That's my favorite thing is a good scanner. Sorry.
No, and that's
true.
exactly it. Like, you should be updating your technology because, again, these are things that, hey, it's another $1,000. I'm going to use it. I use it every day for business. You can kind of justify it. Now, less common would be larger purchases. This is where, like, if you were buying a car for business and you would want to depreciate it over time, like if you weren't taking the standard mileage deduction, or if you bought that $1 million boat, like we were talking about, you may want to depreciate that value over 5 years or 10 years, whatever, to be able to reduce your taxable income. But for most of us, that's much less common.
Question.
Sure.
What about gimbals, cameras,
Absolutely.
microphones?
Yep. That's all part of your marketing. So what you need to do is track what your business purpose is for using that. So new gimbal for social media marketing. That would never raise a red flag because that's standard. That's something that a lot of agents do. You know, TikTok and social media is very popular for real estate agents now. So yeah, having gimbals, having things like that, those are reasonable expenses for a real estate agent. So you'd be totally fine with
Oh,
Absolutely.
Yeah, absolutely.
that. For me, for the photography company, I'd go buy a new camera, I buy a new drone, I buy, whatever. That's an expense for the business and it's reasonable. Photographer, I
Do you
should be
have
buying
them-
new
Do you have
cameras.
them separate, like from
Mhm.
your real estate?
It's a separate LLC,
Okay, cool.
yeah. But again, as a real estate agent, if you do any of your own photography, you can write off a new camera, a new flash, new whatever.
Do you have it structured under a holding company, or you just have two separate LLCs?
I have two separate LLCs for now. Eventually, I'll probably put everything under a trust and then restructure it. But with everything being so new, I just haven't done it yet. Some other things, excuse me, insurance and professional services. We carry E&O for all of you, but some agents choose to carry their own E&O policy. If you do, that's an expense that you can write off. Business insurance, CPA, and bookkeeper fees. So when you pay your CPA to do your taxes, that's a taxable expense. So typically you're going to pay them this year. So on this year's taxes, what you paid for them to do 2025 becomes an expense in this year. Business-related legal fees, coaching and mentoring. This is one that gets missed a lot. If you've got a real estate coach, if you have, social media mentors or whatever that are teaching you how to do this, all of that becomes a reasonable expense for your business. Transaction coordinators and virtual assistants. That's another one where we don't think about it. Like we pay our TCs at closing, but because we are paying them directly as a transactional type service, that's a reasonable thing for our business to be able to write off. So your CPA fees are deductible. Not using the CPA is the expensive option. The CPA put that in there, so I just left it. Meals, travel, and networking. So this one gets a little bit funny, but it warrants talking about. So client meals, business meetings, food for open houses, those are typically 50% deductible. Thank you, ladies.
Guys, thank you so
It
much.
was so good to see you. You can unlock that door and it'll let you out.
Oh,
There you go. So client meals, business meetings, and food for open houses, those are all things that you can write off. Typically, it's 50%. If you go have a client meal, you can't write off your food, but you can write off theirs. That's kind of how they look at it. Be sure to track who you met and the business purpose for each one. So it's not just like, oh, my husband and I decided to go out and have dinner and suddenly it's a business expense. Like there has to be a legitimate reason that you did it. And then if you travel for business, now this is where it becomes really tricky. And again, this is not legal advice. This is just something that I've been told by a CPA. If you have your business structured, so you're not a sole proprietor, but you're actually like an LLC or whatever, what you do is you turn your vacation into a business retreat. You have to have a formal meeting, like there's a bunch of rules that go into it. You can talk to your CPA to figure out how to do it. But what a lot of people do is they take their family vacations because again, they pay their kids the $600 a year or whatever. That family meeting, as long as you can show that you structured it properly, your airfare, your lodging, your gas, all of those become business expenses. So again, I would encourage you to talk to your CPA about it because you have to do it exactly right in order for the government to not go, that looks a little fishy. But there are ways that you can do it where your family vacations become business expense. Banking and financial. So if you have any fees associated with your business bank account, not your personal account. So that's something important to understand. If you have any credit card processing software, most of us don't. Wire fees, we don't typically send a lot of wires, merchant services, but accounting software. So if you're using QuickBooks or you're using something else to keep track of your finances, that is an expense. Having separate accounts or cleaner deductions. So if some of your stuff is in your personal account, some of it's in a business account, that's where it gets to be a little bit more fuzzy. Health and retirement. So again, as 1099 contractors, you don't have employer, unless your spouse has it, you don't have employer provided health care. That means it's an expense for your business. So you can do self-employed health insurance premiums. Those become part of your business expense for the year. A SEP IRA, excuse me, a solo 401k. Again, your CPA will tell you how to structure this properly, but these are things that, again, often get overlooked, that we don't have a 401k from our employer. So we have to contribute to that ourselves. And by doing so, those are the types of things that become business expenses. Now, probably as important, if not more important than what I've told you that you can write off is what you can't. So personal expenses, personal groceries, supplies, family vacations, with the caveat that if you structure it properly, you might be able to, but normally no. Clothing that you would wear outside of business. So what a lot of my agents do is if they spend a lot of time in the gym, they have their gym wear embroidered or screen printed or something that has the business name on it. So then now their gym wear is business expense because it's marketing. As real estate agents, we market everywhere we go. That's why we always wear our name tags. I don't, but we should. Gym memberships, unless they're medically prescribed, are not typically a business expense. Haircuts, nails, cosmetics. There are agents who try to write off getting their nails done because they argue that that's part of the way that they present themselves.
Of course.
I
believe that.
Yeah.
I do.
But the CPA has said this is typically something that's not deductible because
Should be.
it should be, but that's a whole other conversation. And then personal streaming services. So, your Netflix, there's not really a reason that you would need Netflix. I mean, we could argue that there's a lot of business purposes, but the IRS doesn't tend to agree. For your vehicle, personal errands that are counted as business or mileage without logs, that can get you into trouble. Sorry. Home office, guest bedrooms that are used sometimes. So for example, like if it's primarily a guest bedroom that you occasionally use as an office, you can't write that off. Or mixed use rooms. I've got a bonus room that's got a pool table and, arcades, but I've also got a desk in the corner. The IRS is not typically going to allow you to use that whole space. Aggressive or unsupported write-off. So again, using 100% of your phone or internet without being dedicated. The IRS is not stupid. They know that we're using our phones for mixed purposes. So don't be greedy. Like 80% of your phone bill is still a pretty good write-off. Just be reasonable with it. Claiming deductions without documentation, or my CPA said everybody does it. That's another one. I've had CPAs, it's like, oh yeah, this is common. And then you go through and find out, I talked to another one a year later and they're like, oh, no, I would never do that.
Mhm.
So you have to kind of be careful about what you can and can't deduct. A couple of best practices to stay safe and stress-free. Have a separate bank account for business purposes. I know this is not always practical, but as much as you can, having a separate account that all of your business stuff runs through. Having either a business credit card or a card that you just use for business. So what a lot of real estate agents do is they say, hey, listen, anything that's going to happen in my business, I have this one card and everything goes on that card. So at the end of the year, you can just print out your statements and you know that anything that went on that card was just for business. Mileage tracking app, scan your receipts and save digital copies because again, paper copies can become unreadable. And then review and track your expenses monthly. This is a really good suggestion because there are times I'll look at a receipt and go, that's 3 months ago. What the hell is that for? If you're doing it like once a week or once a month, it's much easier to remember, like, what was that expense? What did I use it for? That kind of thing. Good returns, good records turn deductions into confidence. Now, should you register your business? So again, this is a little bit off track, but while we're talking about taxes, it kind of, at the start of the year, kind of makes sense to have this conversation. So most agents operate as a sole proprietor. So you are a licensed individual, you get paid as Greg Blackall person, right? In that case, you are a sole proprietor. It's simple, there's no setup costs, there's no liability separation, which again, we have E&O that kind of mitigates that somewhat, but your self-employment tax exposure. So again, if we make $500,000 in income this year, we're paying that self-employment tax. An LLC or a PA is your most common upgrade. So it does create legal separation. In a PA specifically, which is what a lot of I don't know about a lot, but I think we've got 3 or 4 agents that have set up themselves as a PA. One of the big things, and I think it's on the next slide. Yeah, it is. So I'll talk about that in a second. But electing an S Corp taxation, so basically your business is taxed separately from your personal income. Pay the agent a reasonable salary. So if you made $100,000 in income last year, from transactions, commission income, things like that, and you paid yourself $150,000, it's going to raise some questions like, what are we doing here? So pay an agent a reasonable salary. Reasonable is a percentage of whatever you earned throughout the year. So reasonable doesn't mean a $50,000 a year salary because maybe you made 500 grand and 50,000 wouldn't be reasonable. But again, it's kind of in line with what you make as to what reasonable becomes. And then distributes the remaining profit as dividends. And again, your CPA will get way farther into this than I ever would. But you pay yourself a reasonable salary, and then at the end of the year, if you've got money left in that account where you're like, hey, okay, cool, you can pay it as a dividend, and it's not subject to self-employment tax. So a PA is a professional association, which is a corporate entity specifically designed for licensed professionals. In Florida, real estate agents are allowed to operate as a PA. So if you go and become a PA, like you register for it, they'll get you set up. Your tax ID, like you're on your license, it will say Natasha Alonso PA. And your tax ID is now your EIN rather than your social security. So you become an actual taxable entity separate from your person. So it gets treated like a corporation. It can be taxed as a default C or an S Corp, which for us, an S Corp makes way more sense. So a PA is not a tax strategy by itself, but it's a legal structure that helps support your tax. So again, if this is something that you think you might want to do, A strong candidate for a PA is somebody who consistently makes 120 to 150 GCI, planning to stay solo with no partners. You want an escort tax treatment, higher credibility with lenders, and treats real estate as a long-term profession. Again, if this is something you think you might want to do, I would encourage you to talk to a CPA or an accountant. They can help you determine whether or not this makes sense. Sorry. So again, this is somebody who's been in real estate for a while. They're making consistent money, things like that. This is not something that I would encourage agents to do right out of the gate. So I think that is, yeah, that's the end of that. Questions? I know I kind of threw a lot at you guys, but
No, I don't have a question. I'm a LLC with an S corp
Mhm.
because I'm horrible at taxes, and I did everything that you said.
mhm.
I have a separate card that I do everything on, and the so you tell yourself how much you want to make, and then your CPA, like, they do it all. They take my. So if I'm gonna make $1,400 a month, and they pay the government taxes. So
Right.
for me, it's like simple.
Yeah.
Because I was horrible. So just I'm not organized. I don't do anything right. So this was the
Now
one
you can.
thing that I have done that I'm just totally happy with.
Yep.
So
And that's the
Anyway,
thing, like setting
yeah.
up as an LLC and things like that, where you pay yourself a salary, you get
Yeah.
the benefit of being W-2, you get the benefit of showing that you're a W-2 employee, but you still get to retain the benefits of writing off a lot of these things as business expenses. So it kind of becomes a best of both worlds kind of scenario.
I just
It's well worth it. And again, like when you're new and just starting out, a sole proprietor is fine. Like you're going to pay yourself, you're going to have the self-employment tax. You're not going to make so much money in your first year or two that it's going to necessarily matter. But as you're consistently, like after this year, after we build you guys into huge productivity, then maybe this would be something to look at. But I just wanted to throw it in here as something to kind of get you guys thinking about.
All right, question about the travel.
Yeah.
Being that you personally deal with different states,
Mm-hmm.
now let's say you had to travel to these states monthly,
Mhm.
write off those flights and anything that you spend there.
Absolutely.
Okay,
As long as you can show the business purpose.
So what I'm leaning towards is I go to Texas every month.
Right.
To see my kids. I'm going to get licensed in Texas to go for the first quarter.
Mm-hmm.
So as long as I'm doing some form of business out there,
Yep.
all those expenses can be written off.
Absolutely.
yeah.
So you can just go see model homes.
Meet
Yeah.
with customers, close some transactions, do something
Yeah,
like that. As
yeah.
long as there's a
Yeah.
legitimate business
Yeah.
purpose for being there,
Yeah.
100%.
We're
Yeah,
gonna
I'm
let it-
still trying to figure out how to
Yeah.
make our Christmas
But yeah,
travel,
It's
because Christy's sister bought a home with me. So I'm like, oh, I was visiting a past customer and I'm looking at maybe opening an office in St. Louis. I don't know when, but we drove by a few vacant spaces and I went, no. Okay. So, I'm trying to figure out how to make it, but that kind of thing. Like there's a legitimate business purpose for being there. Absolutely. That's a business expense. So yeah.
He inspired that.
Awesome.
There you
Any other
go.
questions, concerns, rotten tomatoes to throw it?
No, you're very good.
Awesome.